So you've decided to start investing in real estate. This can be one of the best decisions you've made for your financial future. On the other hand, it can also be the biggest headache you've ever dealt with. There has always been a debate in the real estate world about whether it's smarter to buy a single-family home versus a multifamily. And although both has its pros and cons, in this video, we'll share the benefits of investing in multifamily properties and why this is the best way to build wealth through rental properties. In return, take a few seconds and subscribe to the channel because we post videos every single week teaching you the ins and outs of real estate investing and owning rental properties. Don't forget to turn on the bell so you don't miss out. So what exactly is a multifamily property? For the sake of this video, we'll be focusing on small multifamily property, which is a property consisting of 2 to 4 units. The reason for this distinction is simple. One unit is simply a single family residence, while more than 4 is considered commercial property rather than residential. This means that 2 to 4 units are still considered small multifamily residence despite having more than one unit. Now, commercial property can be more difficult to finance for a beginner, so it's a good idea to start with something residential. When you go with a small multifamily property, you gain many benefits from the economics of scale while still dealing with a property of a more manageable size. Now, these 2 to 4 unit properties are typically classified by the number of units the property has. A 2-unit property is often referred to as a duplex, while a 3-unit is often called a triplex, and a 4-unit can either be called a fourplex, a quadplex, or simply a quad. Now, why should you invest in small multifamily properties? There are plenty of reasons why someone might want to invest in a multi-unit residential property as opposed to a single-family home. Fundamentally, you're purchasing a single property while gaining multiple rental units. This is a great way to get a head start when it comes to building a strong portfolio of income-generating properties. You can build up a solid amount of cash flow much more quickly compared to buying a series of single-family homes. By buying 3 or 4 times as many units, you might expect the price tag to match, but in reality, as more units are included, the cost for each individual rental is reduced. For example, a duplex may only cost 50% more than a single-family home in the same neighborhood despite having twice as many residences. This makes it far more efficient to purchase multifamily property if your goal is to acquire a robust portfolio of rental properties as rapidly as possible. Now, another benefit to having multiple rental units right off the bat is that your investment is immediately diversified. When you own a single family home and the tenant decides to vacate or refuses to pay rent, your investment suddenly stops generating income. However, should this happen with the multifamily property, you still have other tenants that are helping cover your costs. Now, there is another strategy that is possibly one of the greatest wealth generating tools available to homebuyers. This tactic is commonly referred to as house hacking. When purchasing a property with multiple units, you have the option to move into one of the units yourself and rent out the others. Ideally, you can use the rent collected from your tenants to pay all your expenses associated with the property and essentially live for free, completely eliminating your housing expense. This is critical because for most people, housing is their biggest expense, and house hacking aims to greatly reduce or even entirely eliminate this. In some instances, you can even achieve positive cash flow from the remaining units and get paid to live in your own home. All the while, you are accruing equity in the property while your tenants pay your mortgage for you. When you plan to move into a small multifamily property, you also gain access to simpler and more accessible financing options available to primary residents. This has the advantage of a lower down payment, making these purchases much more attainable. Now let's talk about how to choose a rental market. The first steps in any real estate investment is determining where you're going to buy. Every investor has different criteria to consider when choosing the perfect rental market. If you're relatively new to real estate investing, it's strongly recommended to purchase your property in a location that's accessible to you in case of an emergency. This can be difficult when you live in a high cost of living area, like for example the San Francisco Bay Area. However, it's usually possible to find something a bit more economical within a 2 to 3 hour drive. Also, when considering different rental markets, there are a few other factors to consider aside from proximity to where you live, such as the price to rent ratio of the property. A typical rule of thumb is the 1% rule, which states that the monthly rental income of an investment property should be equal to or greater than 1% of the purchase price. Although it's helpful, it shouldn't be taken as a strict rule because this isn't attainable everywhere, and there are other factors that contribute to this decision. Now, you may have heard the common real estate investing advice to purchase property in the path of progress. This simply means that you should be buying in an area that is likely to continue developing, and therefore home prices and rents in the area are likely to rise over time. Two factors to consider that indicate whether an area is a candidate for significant appreciation is population growth and the makeup of the local economy. An area's population steadily growing beyond the national average trend is a good sign that the area will continue to grow and develop in the future. On the other hand, a location with a stagnant or depleting population likely indicates that people are on their way out, and with them, prices and rental rates are sure to follow. When evaluating the jobs that make up the local economy, it's important to look for diversity among the industries that fuel it. For example, the last thing you want for a rental market is for all of the jobs in the community to come from one factory. In the event that that factory were to shut down, a huge portion of your potential tenants would suddenly be out of work and unable to sustain rental payments. So let's talk about what to look for when purchasing a multifamily rental. After you've settled on a market that you would like to purchase investment property in, it's time to choose the specific property that you'd like to buy. As an investor, the most important factor should be based on the property's finances. When using the buy and hold method, a very common metric is the capitalization rate or the cap rate of the property. Cap rate is determined by dividing the NOI or net operating income by the total purchase price. It's frequently expressed as a percentage that indicates the value of a potential investment. NOI is also a very helpful number for determining exactly how much income the property is able to generate. To determine NOI, you need to add together all the income the property will produce. Include all the rents for each unit and any additional income producing space such as paid storage, parking spots, or coin-operated washer or drying machines. Next, subtract all known expenses. The only expense you should exclude from this calculation is your monthly mortgage payment. Aside from that, subtract any taxes, insurance, utilities, or HOA payments that may be associated with the property. This should leave you with the net operating income, and if this number exceeds the monthly mortgage payment, you've got a cash flowing property on your hands. Now understand that purchasing small multifamily rental property can be the perfect solution to getting your portfolio started. Whether you're house hacking or simply acquiring rentals as quickly as possible, all of your financial goals are within reach when you utilize the most common asset class for creating long-lasting wealth. Now, real estate is one of the most powerful investments you can make in your life. Armed with the necessary knowledge and skills, you can quickly amass a huge amount of assets that generate cash flow. Now, this will allow you to pay your living expenses without the need to exchange your time for money like at a 9-to-5 job. That's the true power of financial freedom. Now, we hope you found this video helpful. If so, take a few seconds and smash the like button down below. And don't forget to subscribe to the channel so you won't miss out on our upcoming real estate content. We've also put together a playlist that will walk you through every aspect of investing in rental properties. So go ahead and check those videos out as well. And until next time, we'll see you guys in the next video.